Raise your hand if you've heard this before. We manage capital in a beta neutral, factor constrained approach. We underperformed because our portfolio was underweight momentum and size factors. The crowding factor is having a -4 standard deviation move today. Powell was dovish or hawkish, and a pot is blowing up on a factor rotation. I would prefer not to cover that short. It would exacerbate our excess beta exposure. Or if you're working in a multi-manager, you get the call, hey, I need you to get your book from 68 IDEO to 75 IDEO. These frameworks are all part of the modern nomenclature of institutional hedge fund investing. And one of our guest speakers in the Factors for Fundamental program said it best, that 20 years ago, no fundamental stock picker was thinking about factors. Today, many stock pickers are thinking about factors. And in a few years, all stock pickers will be thinking about factors. The others will have gone extinct. Now, there may be a bit of hyperbole in that statement, but I think it reflects the underlying direction of travel of the broader risk management environment in the hedge fund industry. Why is this a case? As I think about markets, I observe three dominant trends in equity markets over the last decade plus. Number one is a trend towards indexation and active versus passive. The index share of S&P 500 has gone over 50%, and you've seen steady, consistent outflows from active funds into passive indexes. Number two, you've seen the rise of thematic and factor-based ETFs. Global thematic ETFs have gone up 6x to 120 billion over the last 6 years, and factor-based ETFs have also gone up to over 1 trillion by 2021. These are specific factor ETFs on strategies such as value, momentum, low volatility, etc. Collectively, thematic and factor ETFs have become $1 trillion plus business, and more because there's many internal quantitative funds or macro funds that are expressing similar thematic and factor bets. And third, you've seen the rise of the multi-manager firms like Citadel and Millennium and Point72. Over the last 12 years, multi-manager funds have gone from 92 billion to 311 billion and really have driven all of the incremental growth in the hedge fund ecosystem, leaving the remainder of the hedge fund industry in a low or no growth trend over the last decade. These firms have some distinct approaches in their investment style. They think about volatility as risk. They think about a separation of concerns to IDEO and factor. And they really are oriented towards constructing what is often called an alpha machine. What does that mean? It means taking an underlying equity exposure, leveraging that equity exposure up, often roughly at a 5x multiple, 500% gross exposure, and approaching a portfolio as a pure beta neutral construct, going long 750, short 750, with the ultimate goal of generating alpha based on the long-short spread of your longs and shorts. On a gross basis, that approach doesn't always generate eye-popping returns. It can generate 2, 3, 4, 5, 6% returns. But an 8% long-short spread or roughly an alpha exposure performance in this environment leads to very good underlying performance on equity due to the gross exposure of the portfolio and then the underlying leverage of the portfolio. This is a simple example but has broad implications for the orientation of investment and risk management. Given the leverage in these portfolios and the orientations towards capturing that pure IDEO alpha, these firms have a very sophisticated mindset when it comes to what is IDEO and what is factor. There's also a concern about correlations. The correlations are critical, and there's generally a sum of squares mindset in the sense that P&L is additive. If I have 4 sleeves or 4 PMs, I can add that P&L up. But to the extent that the risk is diversified and orthogonal, that vol doesn't simply add up. That vol can be a sum of squares. And so if I take 4 portfolios with a 3% gross return target, all at a 1 sharp performance, due to the sum of squares dynamics of risk mitigation, of risk diffusion, those underlying sleeves or underlying portfolios can turn into a 2 sharp at the portfolio level. And this is a really compelling value proposition for the end allocator, for the end limited partner. These firms have grown in terms of headcount, in terms of assets under management. In fact, if you look at Goldman Sachs report, a number of these larger firms now have headcounts anywhere from the 2,500 to 4,500 range. So these are very, very large firms. Notably, they have much higher headcount ratios. They're less capital efficient due to the coverage models. And so these multi-manager firms have a consistent and very strong appetite for good investment talent. Subsequently, in any sort of surveys, conversations with headhunters, multi-manager firms tend to be consistently hiring new talent. And in a lot of the ways, these firms provide a strong value proposition for talent, including financial guarantees, protection against netting risk, a PM in a box approach where many firms will do single manager lift outs, bringing an entire team over, pathways to multi-billion dollar portfolios, and helping solve some of the single manager challenges in launching and scaling a portfolio that exists in today's capital raising environment. Now, these 3 trends are driving 3 underlying shifts in the approach to equity markets. First, they're driving a collective shifting definition of what risk is. Due to the rising sophistication of risk management, definitions of risk become more precise and more constraining. Investors are increasingly living within the constraints of a risk model in a multi-manager, or they're competing against these large pools of capital that are factor constrained. Either way, factor frameworks have increasingly influenced price discovery in the markets. Definitions of beta are shifting. Institutional LPs have become more sophisticated. The old days of paying 2 and 20 on a black box equity long short fund are less prevalent. And the mindset today from allocators is, I'll pay high fees for alpha, but I want to access beta at a low fee. And what constitutes beta is expanding to include factor beta, factor P&L. You also see a rising retail participation, and retail commonly has a bias towards thematic and factor-based investing. If you take these 3 trends together, the incremental price setter in equity markets has shifted over the last decade. Indexers, thematic and factor ETFs, and multi-managers have increasingly become the incremental price setters. And these trends have trade duration and thematic expression consequences. New opportunities in alpha pools emerge, such as the new hedge fund strategy of fading pod brain, which we will talk about a bit in this program. But ultimately, our view at Fundamental Edge is that understanding the new constraints of these market participants to either thrive within those constraints or to arbitrage those new alpha pools that are emerging due to these constraints is an important part of the continued evolution, strategy evolution, and learning process of institutional investors. We use the course analogy of a poker table and the argument that yes, it's important to understand the cards on the table, but similarly as or even more important to understand the players around the poker table. To understand that different market participants have different constraints, have different mindsets, and that increasingly the multi-managers, the indexers, and thematic ETFs are exerting a very strong influence on price discovery in the markets. A key part of this driving force has been the sophistication of allocators or limited partners, entities like foundations and endowments and pensions and family offices, high net worth individuals and RIAs. that conduct, an increasingly sophisticated allocation process before they're allocating to a hedge fund, institutional investment portfolio. And really, a key driver over the last decade is that the mindset of alpha versus beta, that I'll pay 2 and 20 on a full return stream, with that return flattered by beta, market beta, and factor beta, has in many cases shifted to the new paradigm of a more sophisticated return decomposition approach, where I will pay for alpha or I'll pay for IDEO, but I want to barbell my allocation, where I'm paying low fees for beta or factor P&L, and I want to pay high fees, I'm willing to pay high fees for true alpha, but I want to ensure that that alpha stream is true idiosyncratic performance that I can't access with a low fee factor ETF. What does this mean for fundamental investors? It means that business models have evolved. The single manager hedge fund business is a more strained winner-loser market with general fee compression. That doesn't mean that there aren't some wonderful, successful, thriving single managers in the world, some wonderful, successful, thriving new launches. It means that in general, there has been more pressure on fees and more focus on return decomposition. This means that there are employment considerations, with more investment professionals moving to the multi-manager world, where there is the new constraint introduced of the risk model. There are allocator considerations as the institutional mindset has evolved to pay for alpha, to pay for IDEO, and attempt to pay, for low alpha, pay low fees. And there are price discovery considerations in the market, with more factor volatility, factor crowding, put selling dynamics, where a factor may generate great alpha for a period of time, but then ultimately have a crashy dynamic on a factor rotation. The constraints of multi-managers have implications when it comes to trade duration, when it comes to allocation of capital during a volatile period in markets. And generally, you've seen a hollowing out of the value investor community towards more investors that have a focus on generating monthly consistent P&L. And I would note, when we start to think about price discovery, all three of these trends, the trend towards indexation, trend towards factor ETFs, and trend towards multi-manager, are more market microstructure or asset allocation considerations, not primarily a bottoms-up fundamental consideration. Right? And there are ways that we'll dig into that I think this opens up new alpha pools for deeply fundamental bottoms-up stock pickers. I've been very fortunate in my career to have a front row seat for the evolution of these dynamics. I started in the hedge fund industry in 2008 and had the great ability to work at a deeply fundamental bottoms-up Tiger-style investment firm, and then ultimately was a portfolio manager at 4 leading hedge funds that had a very sophisticated approach to risk management. I would note that this will be the only slide in the program where I mention my former employers. All content of the program will be illustrative, non-specific, and will not derive or represent any proprietary information or strategies from any specific employer. I will talk about some of the high-level lessons from my transition to a fundamentals first, highly focused fundamental world, to a world where I was considering balancing the book and trying to express fundamental ideas within the constraint of a risk model. For me, this required new skills, and there were no great ways to develop those skills. Initially, a quant at my firm recommended that I read the book by Grinold and Kahn, Active Portfolio Management. I was a state school finance undergrad, and I understood about 20% of the book. There was pretty complex math that didn't quite resonate with me or wasn't as accessible as I needed it to be. I had to learn the hard way through weekly meetings with the quant research team, trying to identify and read any factor white papers or academic research I could find. And then ultimately, when Giuseppe Paleologo introduced his book in 2021, Advanced Portfolio Management, a much more accessible book that did become a niche hit in this area. We're very fortunate to have Giuseppe as a guest speaker in this program. We expect to use advanced portfolio management as a complementary supplemental reading through this program. What I learned that depending on your coming in investment style, this transition to a risk model world can require a new style change, right? You may have to change what has worked in your career for 5 to 10 years up to that point, right? For example, a typical native long-short portfolio may have been only 65% IDEO risk. I may have been taking a lot of factor exposure that I hadn't considered without the constraint of a risk model overlay, right? In a new constraint, to take that portfolio up from 65 to 75 or 80, that might require inclusion, exclusion, hedging, sizing considerations that I might not have had the toolkit to express before. These trends and dynamics are captured in the broader narrative about markets. If you go to Invest Like the Best, the session with Dimitri Baliazny, he talks about wanting to maximize idiosyncratic risks and minimize the factor risks. If you go to the session with Paul Enright, he talks about how that can be a tricky approach because you might end up changing the style to suit your model. These are considerations that we'll dig deeply into in this program. In general, for a new paradigm in markets, we believe that new tools should be developed. We believe investors should have frameworks to understand factor alpha and factor risk, and have the education to understand factor risk models, to understand this broadly shifting definition of risk. I mean, Warren Buffett always said if an investor fears price volatility, erroneously viewing as a measure of risk, he may end up ironically doing some very risky things. If you go to a typical multi-manager, they will very explicitly define risk as volatility. And then they'll decompose that volatility into factor vol and IDEO vol, and they'll want to access your IDEO vol because it's orthogonal to the rest of their strategies. And so these are very different mindsets. The classic value investor mindset of, hey, my risk is the risk of being wrong or of permanent capital impairment. And the multi-manager risk team says, no, your risk is the risk of your portfolio moving up or down. And so these are different mindsets that need to be adopted or at least understood to thrive and compete in this new world. As I was thinking about what's next for Fundamental Edge, I thought to myself, hey, factors and factor risk management was really difficult for me to learn. It was really impactful to my career. First, negatively, the challenge of learning and building within this constraint. And then positively, as I started to kind of get a hang portfolio management in a factor risk world. I observed that successful multi-manager PMs really understood this stuff deeply, not just the basics, but they were able to operate within the constraint in a very effective way. And then increasingly, many successful single manager PMs were learning to fade some of these dislocations that came out of these evolving trends. There's really no great way to learn factors and factor risk management in a comprehensive, accessible way. The best way to do it now is to go get Gappy's book, Advanced Portfolio Management. But we really wanted to create a more immersive masterclass approach. I had the awareness of these trends and these dynamics, but not enough expertise to teach it. But our goal has been to build the definitive masterclass for fundamental investors to learn about factor investing and factor-based risk management. And that's really what we've been working on, and we're excited to announce today. I've recruited 2 experts as instructors in the program. I've recruited Rich Falk-Wallace as a quant instructor who spent 8 years on the buy side at Silver Point, Viking Global, and Citadel as a portfolio manager, and is currently the co-founder and CEO of Arcana, an equity factor risk model focused on equity, risk, and performance. And we've recruited Rocky Cahan, who is the U.S. portfolio strategist at Empirical Research Partners, where he focuses on research from stock selection to macroeconomic analysis. We've also brought in and interviewed 10 really exceptional guest speakers, people like Giuseppe Paleologo, people like Mark Carver and Melissa Brown from MSCI and Axioma, people like Sandeep Varma and Omer Cedar from Equity Data Science and Omega Point, people like Adam Parker, who was a former chief investment strategist at Morgan Stanley, the head of quant research at Eminence, and now the founder of Trivariate Research. Experts in factor investing in the factor ETF world like Meb Faber, Wes Gray, and Wes Sapp. And the allocator perspective from Chad Meir, who's a managing director of the DuPont Charitable Trust. Our goal was to really explore the factor and factor risk world from all angles. We put this together in a masterclass approach with 3 core instructors laying down a core framework and curriculum on factor risk and factor alpha, with 10 guest speakers really fully integrated into the core curriculum. Experts from across the factor investing and factor risk management world to touch on, again, the allocator perspective, the risk manager perspective, the analytics perspective, the risk model perspective, and the factor investing perspective. We've created a structure where there are weekly live Zoom-based instruction classes with replays available, free trials, case studies, and a live factor lab for experiential learning, pre-recorded supplementary guest speakers, supplementary readings, and we're working on some bundle programs with some of the vendors. We'll really explore factors from 2 angles. How can a factor mindset contribute to alpha generation? What are the underlying building blocks of a quant stock selection model and a factor harvesting approach? How do I know if I have a factor exposure in my portfolio, whether that's likely to be a positive alpha contributor or a negative alpha detractor? How do we think about the factor mindset as a distillation of a strategy expression? For example, quality factors have risen in prevalence. Quality factors have a distillation of what many investors want to do in terms of identifying high quality businesses. On the risk management side, many risk managers will say, don't bother with trying to harvest factor alpha. Simply compress your book to a high ideo risk component, bet on your edge and hedge the rest, and use a factor-based risk model to ensure that your portfolio is primarily idiosyncratic risk. We'll explore both frameworks. We'll explore both mindsets with more of a descriptive exposure perspective, not a prescriptive, this is exactly how to do it perspective. We'll walk through some common conundrums that fundamental investors face. Questions like, hey, growth stocks have been killed. When's the right time to lean in? Right? No right answers to that, but there's some different frameworks and analysis tools that can help to make decisions like that. Hey, the Fed is raising rates and I'm thinking how that might impact my portfolio. Hey, I want to pitch a tech long and my PM is asking me what goes on the other side of the book. I want to write an investor letter after a difficult quarter and I want to break down my P&L into factor versus ideo. Or I'm having a compensation decision with an analyst. I want to pay that analyst on an idiosyncratic P&L basis. How can I develop that framework and compensate based on that framework? So we've created a very detailed, roughly 25-hour program in total. That's a 4-week approach. In week 1, we'll talk about factors for the fundamental investor and explain what is a factor and why you should care. Talk about the building blocks of factor analysis, talk about factor attribution, return decomposition, and start to get into the world of factor-based investing, factor-based risk models. Rich and I will be instructors for the live session, and we will include integrated guest speaker sessions into that week. On Thursday of the week, we'll have a case study where we'll consider the optimal factor hedge exposure for a long idea. We'll walk through how a factor risk model works. Well, Rich will go deeply into the guts of a risk model. Melissa Brown from Axioma will talk about the 3 types of factor models and walk through how a fundamental model operates. In week 2, we'll get into factor-based investing. We'll talk about framework for factor-based investing, how to identify alpha with factor frameworks. We'll do a deep dive into common factors that you will hear and what those factors mean. And then Rocky Cahan from Empiric will give us an applied factor investing course. We'll talk about multi-factors and combining factors, the why and setting the table odds, and how timing is critical. And one of the best use of quant tools in terms of avoiding failure or avoiding underperformance. We'll talk about frameworks for factor timing and some frameworks for applying a factor approach as an overlay into your fundamental process. We'll have guest speakers, Meb Faber, Wes Gray, and Adam Parker, and we'll do a case study on constructing a quantamental portfolio. Rocky will give us a quant toolbox for fundamental investors, where we'll talk about the underlying factors and the blending process of factors into a quantitative stock selection model. We'll talk about the question of whether top investment managers are simply skilled factor bettors. We'll dig into the AQR report, Buffett's Alpha, where AQR decomposed Buffett's performance to simple factors such as the use of leverage combined with cheap, safe, quality stocks. We'll think about common investor styles like the Tiger style or the Buffett factor or the Tiger factor, not as factors, but as distillations of elements you might see in a factor model that have historically had trending alpha over time. We'll walk through the underlying structure of quantitative stock selection models. And Rocky will explain certain factors and the combination of factors that lead to very consistent underperformance of stocks over time. There's not necessarily a magic bullet, but there are some shortcuts, some helpful shortcuts when it comes to identifying a higher hit rate for ideas. For example, it sounds simple, but stocks that don't generate gross cash flow historically have a relatively meaningful headwind in terms of underperformance. Other concepts like excess beta or high arbitrage risk also have similar propensity to underperform. Now, none of these factors are 100% effective at all times. They tend to have 60-40 or 55-45 batting average rates. But in terms of trying to identify layers of expected value in your portfolio, I have found that these mindsets, this evidence-based mindset, and implementing some of these tools into an investment process to be a very important incremental source of investment performance. In week 3, we'll dig deeply into factor-based risk management. We'll dig more deeply into the concept of an alpha machine. We'll give you a little primer on statistics and math for the non-quant, and then we'll go deeply into how factor models work, how models think about risk decomposition, volatility prediction, performance attribution, and the expansion of factor libraries. Giuseppe and Sandeep from EDS will give guest speaker sessions on Risk 201 and applying factors. And we'll do a factor case study on how to optimize idiosyncratic risk in a native portfolio. Giuseppe will provide a really wonderful session on essential factor investing, Factor 201, and give some of the aggregated, consolidated wisdom that he's learned over the years in terms of some of the recurring mistakes that he's seen fundamental investors make with factor risk models. Sandeep from Equity Data Science will give a wonderful session on applying factors to your investment process. The last week we'll approach factor-aware portfolio management. We'll give some frameworks, again, not a prescription, but frameworks and descriptions on a PM toolkit for factor-constrained investing. We'll talk about factors, positioning, and crowding, and themes, baskets, and factor-constrained investing. Approaches for factor-aware hedging. I'll give you some of the non-specific lessons I learned the hard way, definitely the hard way, making the transition from a Tiger-style world to a factor-constrained world. And then we'll really close talking about portfolio management in a factor-focused world. We'll do a case study on expressing a theme in a factor-constrained world and give you some insight as to why the rise of multi-managers might be exacerbating the thematic dynamics in equity markets. We'll go into we'll go into the importance of uncorrelated revenue streams in a factor-based vol budgeted world. We'll talk about how P&L is additive, but risk is a sum of squares. And some basic frameworks such as balancing your bet mix or creating more sleeve diversity to ultimately work to optimize your Sharpe ratio in a factor-constrained risk model world. We'll also talk about some of the aberrations and distortions that we see these major trends creating in markets. In some instances, this creates for selling and kerfuffles or certain tactical situations where there's not a clear catalyst path. If you're constrained by the factor approach that you're taking, ultimately that causes more of a consideration about visibility into the catalyst path, the event path. That creates opportunity for old-fashioned alpha pools like time arbitrage or an IRR approach. That creates more dislocations or crowding unwinds that can be arbitraged as a fundamental investor with duration. Ultimately, price versus value is a source of alpha load, and pod positioning can increase volatility, but also make the alpha windows for executing that trade tighter, more time constrained. We'll talk about some risk management approaches that you can apply when you think about either investing within this constraint or investing against the constraint of other players that have this risk model approach. Ultimately, the goal of the program is to be immersive and interactive, and we'll do four case studies as we talked about: the hedging case study, quantamental stock selection case study, an idio optimization case study, and a thematic case study expression. Our goal is to assign these case studies in live instruction on Monday for live instruction and discussion in our Zoom Factor Lab on Thursday. Again, there's no right answers. We'll provide our own answer key, but the goal is really to stimulate thinking and build a skill set so when these situations arise in a real world context, you have some sort of consideration or a menu of options of how to approach these situations. Who should attend? In general, we've designed this program to be the program that we wish we had when we started at Multi-Managers. That was our intention in constructing the course. In general, I believe this should be standardized training for first-time multi-manager PMs, but I think ultimately helpful for all team members at a multi-manager looking to better understand portfolio construction constraints. I don't think it's necessarily targeted just towards the multi-manager professional because, as we talked about with these major themes, fundamental investors broadly are seeking more awareness and literacy on factor frameworks. In a world increasingly dominated by factor frameworks, our goal is to bring awareness and understanding of these trends. Particularly fundamental investors that are either adopting a risk model for the first time or working to become more factor aware, either to introduce new constraints to their firm or to understand the arbitrage opportunities that are becoming available due to these new constraints. The ultimate goal is to help fundamental investors better understand factor alpha, factor timing, and factor risk management. And thirdly, either allocators or risk management professionals, both selectively. The program isn't explicitly catered to hedge fund allocators. More, we will explore the PM, the investor's perspective. Similarly on quants, this is not a program on how to be a quant researcher. It's more a program for the person like me 10 years ago, a state school finance undergrad, fundamental investor seeking to develop more literacy, a common shared language around factor and factor risk models. The program will ultimately have 3 delivery models. We will start with our hybrid cohort-based model, which will launch on February 24th for the first session and run through the end of March. This is roughly 25 hours of curriculum, 8 hours of live instruction, 12 hours of guest speakers that are integrated into the core curriculum, and 5 hours of factor lab and office hours. Our ultimate expectation is to run a spring and fall cohort of the program. All of the sessions will be recorded and available for 12 months in terms of the replays. Ultimately, we will pivot to a full self-paced version, and we expect for larger firms going through an integration or training larger groups of analysts to have a direct enterprise version of the program. The cost of the program will be $2,250. You can enroll directly on our website at fundamentedge.com. There'll be a 15% discount for Academy alumni with group discounts and enterprise seminar versions available. This will be a fully remote program with Zoom-based instruction and self-paced programming. The longer-term vision at Fundamental Edge is to continue to grow beyond our Analyst Academy, ultimately to develop a portfolio or PM Academy. And we view factors and factor risk management as an important building block in that evolution. That probably won't come to fruition this year, probably a 2026 issue. So we view that as a step-by-step approach. Those that are interested in this program will do a retroactive credit for this program when the full PM Academy becomes available. With that, the info session is complete. If you have any questions about anything I talked about in this program, we will be doing some live info sessions, or you could email me directly at brett@fundamentedge.com. Thank you very much for your time.